Good morning.
Good morning.
Welcome to the special, I think just the investment meeting of the Teachers Retirement Board, September 5th, 2024. I'll start by calling the roll. Brian Bergen.
Brian Bergen, representing Mayor Eric Adams, present.
Thomas Brown.
Here. Good morning, Patricia.
Morning. I don't know who. Karina Powell. Gregory Faulkner. Anthony Giordano. And Manny Taveras. Allison Hirsch.
Present on behalf of Controller Brad Lander. I may have to step out if we go late this afternoon, and in which case John Dortz will lead us.
Thank you. Victoria Lee.
Present.
Christina McGrath.
Good morning, Present.
We have a quorum. I'll turn it over to
Great.
Chair.
Good morning, everybody. Welcome back. Hope everyone had a good summer. Great to see everybody. Welcome. So we'll start our meeting, our public agenda with the market outlook presentation. And Mike Fulvio, you want to present the speaker, David?
Yeah, I'll turn it over to our friends from JP Morgan, Blake Johnson and Dr. Kelly. Blake, did you want to kick it off?
Yeah, I'll just do quick introductions. Mike, thank you so much. Blake Johnson, wonderful to meet you all. I work with the Bureau of Asset Management on a day-to-day basis to lend JP Morgan support and resources to the teachers' retirement system and its fellow pension funds here in the city. I am pleased this morning to be joined by Dr. David Kelly, JP Morgan's Chief Market Strategist. In the spirit of TRS, I will say that Dr. Kelly is perhaps our best educator and storyteller on the markets and the economy today. And we are going to offer just a quick but hopefully comprehensive view of where we think the economy and markets stand as we begin September. But if there is any follow-up analysis or commentary or questions that the board would like us to explore before you move on to other critical board matters, I will take that away with your team from Goldman and BAM, and we will make sure to get that done. Dr. Kelly has planned maybe 10 to 15 minutes of remarks and certainly welcomes your questions. Hopefully each of the board members have some of our reference materials and charts, but let us know if you'd like us to share screen, because we're always glad to do that as well.
Thank you, Kelly.
Well, first of all, thank you very much for having me here. Blake, do we just have 15 minutes or do we have a little bit more time for, hey?
Only if the board permits us.
Yeah, we have time.
Okay.
Right. Okay, because I'm not sure I could quite do justice to the rather complex nature of our economy today in 15 minutes. Also, perhaps, Blake, could you share, I think we sent over a presentation.
I would be glad to.
I think it's perhaps we spend a lot of time putting together charts to try to make things clear and vivid, and it's always a challenge. But having done so, we'd like to use them. Anyway, while Blake gets that going here, just as backdrop, I entitled this presentation a longer, wider runway for the soft landing. And I think the right way to think about this is, if you go back 18 months ago, a lot of people thought we'd be in recession right now. And I think to understand where the economy is and where it may be going from here, the first important thing is to understand, well, why aren't we in a recession right now? What happened to allow the economy to continue to grow even as inflation came down? So mainly I want to talk about great, super. Thank you, Blake. So if we move to the next page here, I want to talk about the soft landing, then I want to talk about investment opportunities. So first of all, on the issue of a soft landing, it's not whether we're going to have one or not have one. You know, the plane actually never pulls up to the gate. It's always landing. So eventually there's going to be a problem. But so far, I would say we've been in a soft landing for quite some time. But interestingly, if you go back to the spring of 2023, when people thought the economy was going to slow down, it didn't. And in fact, if you look at this chart here, the long-term growth rate of the US economy since the start of this century has been 2.1%. And if you look at the second quarter of 2024, the economy grew 3.1% year over year. So not only did it not slow down, it actually accelerated. And to understand why, I think you have to look at both demand and supply. So looking at the demand side of the economy on the right-hand side, the American economy is, more than any other country in the world, dependent upon consumers. We have got the most wonderful consumers in the world. We do not stop at the limits of prudence, we stop at the limits of credit. We are more willing to spend money that we don't have on stuff we don't need than anybody else in the world. And that does allow the economy to generate a lot of momentum because it is mostly a closed economy. By spending beyond our means, we in many ways create the means by which we spend. And so what happened was, going back 18 months ago, all the pandemic aid had been spent, credit card debt was rising 15% year over year, the saving rate is very low. It looked like consumers have to pull back, but they really didn't in aggregate. What we saw was, and what we're still seeing is, there has been a pullback in the spending by lower and middle income households. They are getting squeezed. There are about 60% of households today who say they live paycheck to paycheck, and they are getting squeezed. And you're seeing that in food spending, and you're seeing it in clothing spending and other basic items where demand is pretty sluggish. But overall consumer spending is doing fine. And the reason it's doing fine is because the top decile or the top quintile of the income distribution are doing very well. And the top 10% of households in America receive more than 50% of the pre-tax income. So if the first 10, 20, 30% of the income distribution are doing pretty well and they're spending, the overall consumer spending will rise. So I was just looking at data from the TSA, who track the number of people going through their checkpoints every day, and we're still running about 5.5% up year over year over the last 30 days in terms of airline travel. And that will make this year by far a record high in terms of total airline travel. If you look at people booking tables on opentable.com, which again is kind of an upper income kind of thing, those are looking very good for the month of August. They accelerated relative to July. We are seeing some slowdown in light vehicle sales, just 15.1 million units in August. So there's a little bit of slowdown there. But overall, it looks like consumer spending is continuing to grow. And so where do we go from here? First of all, you've got huge increases in wealth because of what the stock market's done over the last 2 years. That is going to fuel the spending of upper income households. Second of all, we've now had 17 straight months, and I think we'll discover tomorrow that we've had 18 straight months of wages growing faster than inflation. And so we are seeing real wage income gains. We're seeing some employment gains. They're slowing, we're still seeing them. And that is generating wage and salary income, which is also keeping consumer spending going. So I do think consumer spending will grow more slowly, but I see no evidence that it's about to collapse. The second big part of this is higher on the right-hand side. If you look at investment outside of housing, that's about 14% of demand. Again, that was supposed to get hurt by higher interest rates, but because of the CHIPS Act, because of the Inflation Reduction Act, which is really a green energy transition act, because of a lot of corporate spending on AI, investment spending is holding in okay. And so when we and those are the big pieces. I mean, housing can't fall very much more because we're chronically short of houses in this country. So housing activity is relatively low, but I don't expect it to fall much. Overall government spending, I think we're seeing state and local governments being able to find workers they weren't able to find before. It's growing okay. So overall, I think the economy is going to slow down to about a 2% pace for the rest of this year and into next year. But at the moment, I don't see any collapse. That's on the demand side. If you move to the next page, just briefly on the supply side, what we show on the supply side is a slowdown in the growth in payroll employment, but it's still been very strong over the last year. Now, we did get a benchmark revision in the last few weeks, which suggested that the payroll growth had been a little bit slower between March of 23 and March of 24 than originally estimated. But we're still adding, 1.8 million, or sorry, 1.7 million workers over the last 12 months, which is substantial given that there is supposed to be no growth in the working age population at all. But we are seeing on the bottom right of this chart, the blue line shows the labor force participation rate of people aged 18 to 64. So there is There's this notion out there that people are sitting on the couch, they're not willing to work. This is not true. We've actually hit a 15-year high in terms of labor force participation in the working age group. But the second thing that's very important, and even more important, is up on the top. In the last 3 years, most of the job growth in America has come from people who were not born in this country. And while the immigration situation at the southern border is chaotic and we are in desperate need of comprehensive bipartisan immigration reform, the reality is that this influx of immigrants is filling out these jobs. And we had we've had job openings are coming down, but they're still at high levels. But we've filled a lot of jobs, particularly in retail, in leisure and hospitality, in restaurant jobs, in daycare. A lot of lower paid jobs are being filled by immigrants. And that is allowing the economy to keep on growing. And if you flip to the next page, the other thing that it's doing, which is really interesting, is it's also allowing wage growth to decelerate. So if you look at this chart here, this chart we put together many years ago, it was to show an obvious inverse relationship. The unemployment rate is high, which is the gray line. Wage growth is low, which is the blue line. But if you look at since March of 2022, now that's 2.5 years, this thing has gone completely haywire, because what we've seen is unemployment staying at or below 4%. It moved up a little bit to 4.3% in July, but I still argue that it's very close to full employment. And yet wage growth has consistently come down. And part of that is a surge of immigrants into lower wage occupations, which is simply because of a mix shift pushing down wage growth. But a bigger part of it, and a really important story, is American workers just don't feel that they have the power to ask for a wage increase. Only 6% of private sector workers are members of a union. The other 94% are on their own. When businesses tell them they can't have a pay increase, they aren't striking in large numbers for those pay increases. We're not seeing a lot of industrial action to push up wage growth. And if you have wage growth of 3.8% year over year, then that is actually consistent with stable inflation. Because if you've got 2% productivity growth, you've got 2% growth in the output prices, that actually means you could afford to push up wages by 4%. It's basically what we're doing. So we're sort of at an equilibrium in terms of wage growth here, and I don't see upward wage pressure pushing up inflation. And then if we move to the next page, on this thing here, which looks a little bit like a stegosaurus with all the pointy spikes up at the back there, we've seen inflation come down. And if you look at the details, you can see why we think it's going to continue to fall. So this US economy is not an inflation-prone economy. We had 40 years in which inflation was falling. And then suddenly, because of the pandemic, the policy response, and Ukraine, we had this spike in inflation in 2022. And by June of 2022, everything was going wrong. Energy prices were up, core goods prices were up, dining, recreation, other services prices were up, food at home prices were up, everything was up. If you look at where we are right now on the far right, the inflation rate is 2.9% year over year. But more than 2 percentage points of that is just auto insurance and shelter costs. And we know these are being mismeasured, I would argue, by the government, but certainly measured with a lag. We know the inflation in these areas is going to continue to fall. And when we look elsewhere, there just isn't any inflation pressure. And so we feel very confident in saying that, bar some extraordinary shock, the inflation rate will continue to come down. I believe that the Fed has a target of 2.0% inflation for the headline consumption deflator. I think we've got a chance of hitting that target in September. And I think overall inflation is all going to be in the twos and low twos as we go into next year. And that brings me, and I don't want to prolong this because I do want to get on to asset classes but also your questions. If we move to the next page, and just looking at the Fed. So the Fed meets later on this month. They would like, first of all, they've said, and I think Jay Powell said this in Jackson Hole very clearly, they are ready to start cutting interest rates. So the only question is, do they cut by 25 basis points or 50 basis points when they meet in the middle of September? I think they would like to cut by 25 basis points. I think they would like to take rates down slowly. And if they don't lose their nerve, I think that's what they will do. But it's tricky because we are seeing mixed economic data. I will say tomorrow's employment reports are very important. What I'm seeing is manufacturing is weak. We know that it's weak globally, but services are very strong, and overall the economy is still growing. It's just growing more slowly. In that environment, the Fed could take its time, and I think they ought to. And so what I think they would like to do is cut in September, skip the November meeting, cut in December, then cut in March, June, September, and December of next year. So 6 rate cuts in the space of 15 months, getting us down to 3 3/4 to 4%. I think that's what they'd like to do. There is a danger that they get bullied into doing something faster. And I think this is the principal danger the economy faces right now. Because what the Fed doesn't know or won't recognize or won't state is that if they cut interest rates by 50 basis points in September, they are more likely to do harm than good. The Federal Reserve often talks about long and variable lags, how long it takes for interest rates to affect the economy. Yeah. The reason they do that, or the reason it does that, is because it's actually a J-curve effect. When the Federal Reserve cuts interest rates, particularly if they cut by 50 basis points, it would scare people into believing, well, what does the Fed know? Maybe we're headed for recession here. Maybe I ought to hold off on expanding a plant or hiring workers or putting out a new product. When the Fed cuts by 50 basis points, people say, well, are they done, or are they going to do some more? They're going to do some more. Of course they're going to cut some more. So do I want to borrow money now? I want to wait a while. Well, I'll wait a while, won't I? So you wait to borrow. That slows the economy down. And then when the Fed cuts aggressively, it also cuts interest income. Now, eventually, those effects fade in significance, and the fact that rates are simply lower and cheaper has a positive impact on the economy, but that comes later. So I think the biggest risk to the economy right now is the Fed gets bullied into cutting too aggressively, and that actually causes the economy to slow down too much. The Fed cuts more aggressively again, and so you end up in a mild recession. That's not our baseline scenario. Our baseline scenario is that we have an extended slowdown, but that's where we see things are right now. And I want to leave time for questions, so I just want to talk about one more thing to move forward. And then just generally in asset classes, and I'm happy to try to address each of them. This chart here we use to try to describe valuations in terms of, across apples and oranges and bananas here in financial markets. So at the bottom, you can see for each of these asset classes, for treasuries or high yield or US large cap stocks, we look at, well, what's the most popular and most important valuation measure? So for large cap stocks, it's forward PE ratio. For treasuries, it's yield to worst. And the horizontal line shows is a 25-year average of that valuation measure. And the dark gray shaded area is one standard deviation above or below. It's sort of a Z-score. And then the light gray area is 2 standard deviations above or below. And so when you look at the chart, what you can see is, okay, US large cap stocks are expensive, value stocks are expensive, growth stocks are expensive, but international stocks are not particularly expensive here, and fixed income is actually looking relatively cheap compared to the last 25 years. I think, I don't want to, as I said, I'd rather open up for questions now, and we can go through each of these asset classes. But overall, I think the economy is healthy, and I think the economy justifies a certain degree of optimism. The question I think we've got to ask ourselves, though, is there has been a lot built on top of this in terms of valuations, particularly in the US equity market, particularly in mega cap stocks. And so we see some concentration risk. There's too much concentration in mega cap stocks in the US market. There's too much concentration in US equities relative to global equities. The US is now 65% of the global equity market. And I think there's probably too much money invested in equities relative to fixed income. And so there's a lot of imbalances out there. And I think one of the challenges is we can see a relatively smooth path forward, but the more times we get reassurance on a soft landing, the more unbalanced the market gets. And so I think the challenge for all investors here is to try to maintain balance, not because they're terrified of what could go wrong in terms of the economy, and something, of course, could go wrong, but the outlook looks relatively okay, but also because their portfolios are drifting out of balance and markets are drifting out of balance relative to fundamentals. And that's what I think people need to focus on right now. So those are the main points I want to make, and I'd love to open up for any questions.
Questions?
Tom,
Go ahead.
I don't know if trustees have any questions, but I'd just be curious, your thoughts on, say, China and the rest of the world and how that'll impact our economy?
Yeah. So there is I think the Chinese economy is in pretty fragile condition. We get data from China. The PMI indices came out this morning. They claim their composite PMI number is still above 50 and stable, but I am very suspicious of all the Chinese economic numbers. What we know is they've got some major overlapping problems. One of them is they've got rotten demographics. Their population is shrinking, and the birth rate is collapsing because the Chinese people don't trust the Chinese government. Second, we've got much more so in the United States. The Chinese, the wealth of Chinese households is embedded in property. One of the advantages the United States has over many other countries, and I think other countries realize this, I don't think we realize it, is so much of our wealth is in the stock market, which is not as prone to economic problems as the housing market. But in China, they way overbuilt. The property is way too expensive. The vacancy rate is enormous. We know that home prices have to come down, particularly with negative demographics, and that is undermining wealth among Chinese consumers and further making them negative, and it's causing them to save more. And so Xi Jinping would like them to spend more and do more consumer spending. They just don't want to do it. A third problem they have is more generally the level of control which Xi Jinping is imposing upon the economy. There had been a very steady opening up of China in all the years after Chairman Mao, particularly under Deng Xiaoping, but other Chinese leaders all the way up to President Xi. And that opening up had, I think, encouraged a spirit of enterprise and entrepreneurialism among the Chinese people. The fact that the government is being more aggressive in imposing its view on, say, private education or on information technology on the Chinese people make the consumers less willing to be aggressive here, and indeed make small businesses less willing to be aggressive. I mean, Chinese people, in my experience, visiting there and also with Chinese relations, is they're not always going to say exactly what's on their mind, and they can't in China, but they can speak rather loudly with what they spend money on or don't. I think that Chinese consumers are nervous. I think also the aftermath of COVID has made China's relationship with the rest of the world even more difficult. So I think China's facing a lot of problems here. I don't think it's enough. I think the Chinese government has every interest in keeping things afloat. I think that the problems that China faces economically actually reduce the risk of any foreign adventure like Taiwan or anything like that. I think the Chinese leadership does understand the importance of trying to cool tensions with the rest of the world and try to help their economy expand and help their export markets. So I don't expect any foreign policy adventures from the Chinese government. At least I hope I'm right in that. But I do think that they're going to have a difficult time with it. So long as China doesn't collapse, if it just grows slowly, then the slowness of Chinese growth is enough to, I think, hold down global commodity prices. We're seeing oil prices have backed off a bit, partly because of the weakness out of the Chinese economy. But I also don't think it's enough to put the global economy in recession. We're seeing a lot of reshoring out of China towards countries, particularly India, Southeast Asia, Mexico. So there are other developed countries or developing countries who are taking up the slack for China. The overall global economy, I think, will continue to grow. But I think China really has to recommit itself to the path that Deng Xiaoping put it on before China can really begin to work through its problems.
Thank you.
Anthony has a question.
I promise a shorter answer to the next question.
I stared at that last chart you had up, the valuation chart of the asset classes. I stared at it this morning at about 1 a.m. for about 10 minutes, and I was fascinated by it, and I just didn't get it. So I was hoping that you could maybe just give me a 1-minute synopsis on that chart and how do we draw the conclusions, and what do we pull out of it as fiduciaries and trustees?
Okay, Blake, can you pull that back up? Super, thank you. And we do so. So what we did here is the one of the things one of the problems I think that we have, or that a lot of investors have, is they're talking to me about individual asset classes on their own. But what we wanted to do here is show valuations across asset classes, and obviously there are different valuation measures, but all of them can be reduced to a Z-score. So if you look at, for example, over on the far right, the forward PE ratio, well, if you assume that PE ratios are normally distributed, then that dark gray area represents the area in which about 2/3 of PE ratios have been over the last 25 years. And the light gray range looks at the range that PE ratios have been within about 95% of the time. So when we're at 1.58 on and that the green dots are where we are right now, that means that the PE ratio on large cap stocks is higher than it's been probably about 85 to 90% of the time over the last 25 years in terms of price to forward earnings. But then the beauty of this approach, since we reduce everything to a Z-score, just where is this valuation measure being relative to the last 25 years, is you can then look at that relative to treasuries. So treasuries are cheaper than they've been. So it's not quite down to one standard deviation. So they've probably been cheaper than they've been, say, 60% of the time or 70% of the time over the last 25 years. And what we mean by that is the yield worse has been higher. So they've got higher rates because we've been in this period of rate suppression. So the way I'd interpret that is, it's not that treasuries are particularly cheap or a huge bargain or you're going to get great returns on them. It's just that they were a lousy bargain for most of the last 25 years. And now that is not the case. And then if you also look at EM equity and DM equity, you can see that those are, one of them look at price to book and the other one look at price to equity, but both of them are at or below their averages. And if you flip forward a few pages, we can just briefly here on this page here we look at the equity market and look at PE ratios in the equity market. So you can see the top 10 stocks are much more expensive than everything else. On fixed income, if you flip back a page, and I'm almost done here, then you can see that those blue diamonds suggest that yields are actually better than they've been on average over the last 10 years. And then if you go forward again, I just want to go forward one more. Yeah, and we'll stop here. And then if you look at this here, what we show here is the way we look at international stocks. We could look at it on just a valuation basis, but I like the chart up on the right because it just shows just how big the US share of global equity markets have become. But anyway, the first chart that we were talking about, we just look at it as a way of comparing apples and oranges and bananas across different asset classes.
Thank you very much.
Thank you. Any other questions? Thank you so much for coming, Dr. Kelly. You're
very welcome. And if you do have any other questions, as Blake said, just shoot them over to her and we'll try and address them very quickly.
Thank you. Well done. Thank you. Thank you, Blake. Thank you, Blake.
Thank you.
Great. Now we move on to the Passport Fund second quarter 2024 performance review, and I guess Rohit will take that.
Yeah, thanks, Tom. Gina, are you able to pull up our June report?
Yes, do you see it?
Yes, thank you.
Okay.
Can you just hide that window that's covering? So for the passport funds, since we last met just before the end of the fiscal year, we just wanted to spend our first minute or two here on the results through the end of fiscal 24. So looking at this quarter report here, and Gina, maybe you can blow it up a little bit. It's easier for people to read. I just want to focus on that 1 year column. It's going to show us the fiscal year results. And the great news is it was an extremely strong year across the board. Really double-digit returns for each of your passport funds, with the exception of the balanced fund that was pretty close at a 9% return for the year. And really closing out that fiscal year, the second quarter of this year, we saw equity markets hitting all-time highs, thanks in part to those Magnificent Seven, the big tech stocks. Saw continued signs of improvement in terms of manufacturing, in terms of labor market numbers, certainly strong earnings growth, and expectation of the beginning of monetary easing, all of which were really supportive to risk assets. So strong close to the fiscal year for the diversified equity fund, up over 20% closing out the year. And unless there's any questions on June, I'll flip over to share some July numbers. Gina, if you want to switch over to the July flash. Thank you. So July was a little bit more mixed. Certainly after a strong first half of the year, we saw in the month of July positive numbers coming out of the US and emerging markets, but a little bit of modest losses, I would say, in both the Eurozone and Japan. We saw a bit of a small cap rally during July, really in response to this expected start to the monetary easing cycle. The Fed did meet in July and chose to leave rates unchanged, but signaled that they could begin cutting rates, as David talked about, as early as the next meeting, which is here in September. We also in July saw a little bit of a shakeup in terms of the US presidential election, with President Biden stepping out of the race, and Kamala Harris becoming the presumptive nominee during July. So despite some of that uncertainty, we still saw positive results across the passport funds, with the exception of the Sustainable Equity Fund, which does have a bit of a large cap growth tilt and is more impacted by some of those big tech stocks that did see a little bit of a pullback. So slightly negative 1% return for the month, still in very positive territory. Calendar year to date, over 12% return for the Sustainable Equity Fund. And your diversified equity fund, where the bulk of the assets sit, close to 19 billion in the diversified equity fund at the end of July, had a positive about 2% return for the month and up over 13% year to date.
Great.
And the last thing we'll touch on is just benchmark report for August. We don't yet have official numbers on the passport funds, but just wanted to share index returns here for the month. And really in early August, we saw volatility pick up after what has been a relatively subdued market. And particularly in that first week of August, we saw a little bit of investor panic when we saw some worse than expected employment numbers. Thankfully, that market shock was short-lived. We saw some better releases later in the week, and markets recovered. We also, as Dr. Kelly mentioned, had Chair Powell make, again, very supportive comments in his comments in August around expectation that we are at an inflection point with regard to interest rates and moving towards rate cuts later in the year. So again, despite that volatility that we saw in the beginning of the month, we saw positive returns really across asset classes here in the month of August, ranging from 1% for your short-term bond exposure that's part of the balanced fund to 3.25% for developed international equities, the MSCI EAFE index. So despite a little bit of noise, we ended in positive territory for August.
Great. you, Amanda. Any questions for Amanda? Thank you, Michael. Thank you, Amanda. We move on to the pension fund performance update quarterly presentation. Steve is going to take that.
Great. Yeah, thank you, Tom.
Thank you, Steve.
Morning, trustees.
Morning.
I'm a little overwhelmed with Dave's presentation.
Yeah.
Dr. Kelly, I'd actually worked with JP Morgan in the past. I think very highly of him. So he covered most of what I have on my presentation, but I'll try to get through it. Kate, I'm gonna have to ask you to be on top of your game and keep up, because I'm gonna skip some slides. But maybe just go to the first slide, Kate, and just reiterate the point that US and global inflation has moved significantly lower. It appears that inflation dragon that we so dreaded has been slayed. And now we're focused more in the Fed on full employment and in accomplishing their soft landing, their dual mandate. On the next slide, just a quick look at the normal chart you've seen. Actually, we can maybe shrink the photographs on the far right-hand side. We can't see the punchline.
Can you move it so that they can see?
Yeah, of course, you got that. Great, thank you. Thanks. You can see that core PCE is at 2.62%, and CPI, the most recent print, is under 3% at a little less than 290. So again, inflation certainly moved down from the record high, recent record high of June of 2022, 9.1%, and the Fed is declared success in that area. On the next slide, you can see that it's not just a U.S. phenomenon, but a global phenomenon, and that inflation's come down even more significantly in the UK and the Eurozone. You can see on the far right-hand side. On the next slide, just a look, concerns about whether the Fed was behind the curve. They've actually shifted. I know Amanda talked about a change in direction on the Fed. We call it the Jackson Hole Central Bank Symposium pivot, where he's actually declared, and I'm quoting him, that the time has come for policies to adjust. Fed Powell also clearly stated that inflation has declined significantly. The labor market is no longer overheated. And finally, again, quoting him again, with an appropriate dialing back of policy restraint, there's a high likelihood we'll be able to achieve the 2% inflation target over time and a strong labor market. Again, that soft landing. On the next slide, just to look at where we are in really unemployment. Obviously, we're still below where we were at the peak before a global pandemic in terms of the size of the labor force and participation rate. You can see on yellow. But more importantly, on the far right-hand side, you can see unemployment's ticked up a little bit. It's above 4% now, 4.3%. As Amanda and I think Dave Kelly mentioned, we have a big non-farm payroll report tomorrow for August. Expectations are for that print to be around 165,000 jobs created versus the prior month of just 114,000 jobs created. And unemployment is expected to go down from 4.3 to 4.2%, but we'll see. On the next slide, again, echoing what David said, US GDP has actually been quite solid in the second quarter. It is starting to slow. The economy is cooling, not collapsing. We had 3.1% growth in the second quarter year over year versus 2.9%. And again, expectations are for the middle of, say, the 2% range for the current quarter. On the next slide, just look at economic growth. And you can see, again, the disruption growth associated with the pandemic. But more importantly, on the far right-hand side, you can see that really when you look at the UK and the Eurozone, growth is actually flattish. So it really hasn't picked up. The recovery has been slower there. Again, they were also fighting the inflation dragon. And I'll talk about in a moment, though, both those central banks, the ECB and the Bank of England, have already begun cutting rates and are widely expected to continue that later this month. Again, the other takeaway would be the green line. Again, as Dr. Kelly reflected, China is struggling. Their economy seems to be slowing quite dramatically there. And that certainly has implications for their stock and bond markets as well. On the next slide, global interest rates, rate cuts are coming. As I said, it's already occurred abroad. ECB, Bank of England, Bank of Canada, and others have cut rates. We have the next Fed meeting on the September 18th, later this month. Again, the market is fully pricing in 25 basis point rate cut and a 30 to 31% chance of a 50 basis point rate cut. That's just a fancy way of saying the market right now in terms of Fed fund futures contracts are pricing in about a 33 basis point decline in rates at September 18th. On the next slide, this is one of my favorite slides. You can see that the central banks, as I mentioned earlier, Bank of England in yellow, and the ECB in green, have both cut rates at once and are intending, after telegraphing, they intend to do so again. We've been flat. Again, rates are expected to move down in a couple of weeks. And lastly, kind of going the other way here, the Bank of Japan has actually increased rates twice, which gave rise to some disruption early August as the yen carry trade unwind dramatically impacted global markets. I'll talk about that in a moment. On the next slide, just a view that as rates are expected to start moving lower, official rates are start coming down. That also means money market yields, the yields you'll get in T-bills, the yields you get in your money fund where you keep your cash. Those rates are going to start moving lower. They've already have started moving lower as the market's pricing in cuts. But that move here reflects a jump into bonds and notes. Again, expecting that as short rates come down, the yield curve will normalize. You've heard me talk about this. Maybe on the next slide, Kate. Again, I find this fascinating. This has been the longest inverted yield curve in the history of the U.S. bond market. Not necessarily the most abrupt. At its peak, the yield curve had inverted in the U.S. about 102 basis points. This time around in 2022, it was as inverted as 190 basis points in the mid to late 1980s. But it's never gone on for a period of years like it has on an inverted basis, meaning short rates, a fancy way of saying short rates are higher than long rates. Typically, when you buy, say, a 10-year treasury note, you expect to get paid a premium for taking on additional risk out 10 years versus, say, 3 or 6 months. That hasn't been the case. And again, that's reflected here. On the next slide, when we talk about the yield curve inversion, we're really talking, when I talk about, I'm comparing 2-year yields to 10-year yields. 2-year yields have been pretty remarkably consistently higher than 10s, again, for the better part of 2+ years. Here you can see, as of this print yesterday, the yield on the 2-year treasury and the yield on the 10-year treasury notes are both 3.78%. Again, flat. And you can see as that's unwinding on the next slide. This shows the inversion on the next slide, Kate. That red line is flat, where it would be above that, it'd be a positive sloping yield curve, up and to the right over time, over the maturity spectrum. And here you can see it was less than 1 basis point of inversion when this was cut on, I think, early in the morning on September 4th.
Gotta be closer.
Yeah. Maybe next slide, spreads. So spreads have actually come in quite a bit. Remember, they widened out substantially at the outset of the pandemic. They have been kind of bouncing around, somewhat concerned about the potential for not a soft landing, but a hard landing, meaning a recession. Right now, they're at levels that are not particularly thrilling. You typically want to invest in investment grade above 150 basis points. It's at 97 now. And high yield, you probably really prefer to buy it above, say, 500 opportunistically. But what's interesting is on the far right-hand side, if I can just show, I talked about the unwinding of the yen carry trade in early August. So August 5th, the markets really melted down. You had dramatic sell-off in stocks and bonds. And that blip just reflects that yields and spreads have moved out and then come in subsequently within a matter of days. So again, a disruptive August, again, starting on August 5th, but a good ending. On the next slide, in terms of what's going on in the marketplace. So the summer vacation's over. We got back to work. We had the stock market sell off on the 3rd. We had bonds rally on the 4th, and energy actually sold off 8% yesterday on concerns about GDP growth and growth associated with a decline in manufacturing here, but also a stagnant growth and stagnating growth in China and less demand for oil. On the next slide, just to look at benchmark returns through the end of June. You can see Russell 3000 on a 1 year basis. Again, quarter to quarter at the end of June to the end of June 24. Actually performed really well. Russell 3000 up fully 23%. This is not normal. This has been great for your returns, which I'll talk about in a moment. I'll give you a heads up. It was actually quite a good year. But again, you can't really rely on these types of returns. That far right-hand column where it says expected with an asterisk, that is the average of the 5 general consultant expectations for returns across asset sectors over a 10-year period. And I don't mean to dismiss Rokutan or Goldman Sachs in any way. I mean, they have a great forecast. We just thought this was an interesting way of showing it, that it's on average, the 5 general consultants expect to see annual returns of the Russell 3000 at 6.7%.
What was the 10 years before? I mean, what to compare that with?
It's
another
been,
10 years?
actually, US has been pretty healthy. We've been like, coming out of the global financial crisis, and then we actually performance.
Over 12%.
Yeah. Yeah, it's been a really good driver. So John Merceburg is actually the hero within the Bureau of Asset Management because of the performance of the public equities. We have many heroes, though, also in the private sectors. But again, that's not to be expected longer term. Maybe let's skip the next 2 slides, Kate. Those are just, stocks are up and bond yields are all over the place, depending on how you look at it. This slide just reflects again where we are over the last, it's a 20-year slide. Just focus on the far right-hand side. That's fixed income. That's public market fixed income. And as you can see, generally fixed income delivers a positive return. And again, I working with Dan Haas, actually circled the decline in bond performance, which is unusual. And it was fairly significant, again, in 2022, 2023, and then a quick rebound. So we're back in positive territory. Again, Dr. Kelly reflected that bonds look cheap relative to where they were historically. There's actually a lot of noise when you look back in time over the last 25 years. It really hasn't been a normal time. And my forecast is the next 25 won't be normal either. But you look at where we were 25 years ago, we had a dot-com crash. We had a global financial crisis that was extraordinary. We had a meltdown of European sovereign debt. We had banking issues. We had a pandemic. We had currency challenges as well. So, and we also had inflation spike associated coming out of with the pandemic and a ground war in Europe. So not necessarily normal times. We talked about this, Dr. Berman and I have to call him Dr. Berman now. But we debated this last night just in terms of what reasonable expectations are. The only thing we know with certainty is the future will be different than the past. But we use this as the guide because it's the best source of information we have. We try to make judgments around that in terms of how we make recommendations for the portfolios. Maybe skip the next slide. Well, actually, the next slide, Kate, I'm sorry, one back. Yeah, you can see this, just focus on the far upper left-hand side. What sell-off? Again, I think Amanda covered this well in terms of that dramatic dislocation in the marketplace in early August, really peaking on August 5th. And on the next slide, you'll actually see that all of it was reversed out from an equity perspective. Stocks in the NASDAQ was down over 8% at one point. But you can see that's just for the month of August. Everything ended up in positive territory. So again, it was a volatile August. Typically, they're quieter. That may have had something to do with the lack of liquidity. I think it had something to do with the rhetoric out of Japan, the Bank of Japan, and their potential intent to continue to raise rates, which means the yen carry trading and borrowing yen and investing in other currency assets generally to pick up a yield spread and a differential is probably no longer as viable as it had been. Maybe skip ahead 2 slides, Kate. Food for thought. This is great. So we've had some debate internally, and there may not be consensus, but I think this is worth watching. And I'm sure I'll be right at some point. It's like a broken clock that's right twice a day. But this is a concern. The fact that the U.S. Treasury market. So just read through a couple of the highlights. Well, the first one I don't really necessarily agree with because it's not given the time frame. We have government debt to GDP ratio of it's 98, 97, 98. It's almost 100% now. It's moving higher. The one thing we do know with some degree of certainty is irrespective of who is the next U.S. president, that we will be running deficits. And we're running deficits. We anticipate running deficits for at least $1 trillion a year for the next 10 years. We've had $9 trillion of government debt maturing or will mature in the next 12 months. There's a lot more issuance coming out. We have seen less rigorous demand on the part of foreign buyers. And if you look at point number 5, China's actually lowered its holdings in treasuries from 1.2 trillion in 2015 to just 800 billion today. The weighted average maturity of the debt is 6 years. And again, we're coming off of the time out of the global financial crisis and out of the pandemic where rates were very, very low. And as rates have moved higher and the Treasury continues to recycle its debt and reissue new debt to replace what is maturing, the cost of that debt is increasing pretty significantly. Point number 7 is worth noting as well. Typically, you have between 11 and 12% of issuance in T-bills. It's actually currently at 22%. Now, that's kind of counterintuitive in that why would you be issuing in an inverted yield curve at the short end of the curve when it's the most expensive? But because there is so much demand and so much liquidity in the system, the Fed was taking advantage of that and mopping some of that up through T-bill issuance. Treasury auction sizes are expected to increase in 2024. They have been increasing by 27%. So there's a lot more product coming into a market with potentially diminished demand on the part of non-US buyers. And the last point here, and I'll give you an update on the last point the next day, next slide. Interest payments pre-pandemic were about $1 billion a day. $1 billion a day. Maybe skip to the next slide, Kate. They are now over $3 billion a day. The interest expense has gone up significantly. And again, when you look at where we think bonds are, you look at some of the market technicals associated with treasuries and more supply coming, a lot more supply, potentially diminished demand by foreign buyers, you can make an argument that it will have an upward biased impact on yields going forward, long and short. Which I believe will be the case. So again, it's worth watching. We're not in an area where we're not going to be able to continue to finance our deficits, but it is clearly becoming much more expensive to do so. Maybe next slide to talk a little bit about debt. This is actually a look at the investment grade issuance and how it's increased from about $3 trillion outstanding in 2010 to over $9 trillion today. This has to do with bank regulatory reform following the global financial crisis and disintermediation of banks. A lot of these banks, typically, if I were to issue bonds, I'm a corporate issuer. I would go to a bank, I would borrow, or if I were to issue in the marketplace, they would actually support my debt through secondary support. They're really not doing that now. So a lot of the issuers in the investment grade space have kind of gone, and non-investment grade space have kind of going their own way. But again, a significant increase in the investment grade debt outstanding. Maybe skip the next slide, next 2 slides, Kate. This is just food for thought. This is an interesting slide. It looks at the number of data centers. Again, data centers process and store information. They actually fueled by the increased usage of artificial intelligence, which is having an impact on what's required, the amount and scale is required, but also just good old-fashioned cloud technology. And this looks at the number of data centers combined in each country. And you can see on the far left-hand side, I mean, the United States is basically about 10 times the size of everyone else, even though its economy may not be 10 times the size of all the others. It may or may not be, it depends. It just, for me, it tells me that there's been a lot of infrastructure investment. Again, that's reflected in, say, demand for NVIDIA technology, as an example. We are an investor in data centers. We invest in data centers primarily through our infrastructure, private holdings, as well as some real estate. And we have, I think, correct me if I'm wrong, we have some residual data center exposure in private equity. Minor, very minor. But it is interesting. And this either tells me that it's gotten overdone in the States, or there's going to be increased demand for building more data centers in Europe. And I would defer to Petra, maybe give you an update on that at some point, given the fact that her book is more than 50% outside the United States. Maybe skip ahead, Kate, a couple slides. Touch on one thing. I know you asked the question about China. Just some food for thought, some more bullet points. Maybe one more, Kate. One more slide. There we go. So it is pretty extraordinary. The population growth in China has actually turned negative. And I have a slide that follows that shows that. The fertility rate in China is just 1% versus 1.6% here in the States, and 1.2% in Japan. Remember, we talked about the capital market assumptions and the themes that we think will impact returns in your portfolio in different asset classes over a longer time horizon. We talked about demographic changes that are reflected here. Deglobalization. We talked about the sustainability of debt, which has to do with the level of treasury issuance and the cost of that debt. We talked about decarbonization of the economy. There's a number of these things that we think will dramatically impact the portfolio. These are things that are worth sitting up for and paying attention to. The population in China is currently about 1 billion. It's expected to decline about 100 million people each decade. expected to be in the mid 600 million by 2100. That's a significant decline in its current rate. I was watching commentary over the holiday it was a Bloomberg show on the weekend, and the possible solution they reflected here is robotics. Robots to replace people as the demographics shift and there's a decline in.
Do they still have that policy of limiting the number of children?
They don't, but
They
it's
don't.
been hard because it's gotten so expensive, and you have an aging population. You have a lot, people in their late 40s, 50s, and 60s really aren't looking to have a second or third child. But yeah, they've eliminated that policy, Tom, but it kind of stuck in people's mind, and again, it's become a problem for them. We have the same problems here in the States. Again, our I think our replacement rate is probably 2.1. It's only 1.6% in terms of fertility. We have the benefit of immigration. And I recently read a book that talked about the immigration changes and growth longer term. And it reflected the fact that countries and economies may be competing for individuals, immigration over time as this becomes more of a worldwide phenomenon. The only area of real population growth in the world is Africa, and it's going at a pretty significant clip. Now, a lot of those areas are also arid, and climate change will exacerbate those issues. So you may see more immigration out of those areas to other parts of the world, which would be welcome, I think. Next slide, Kate. Population growth. Again, to David Kelly's point, on the far right-hand side, you can see the population growth is now negative 2.5% in China. And again, pretty dramatic change over the course of time. Maybe skip ahead 2 slides to 35, Kate. This is just, I thought this was a cool slide because we talked about the decarbonization of the economy. And this looks at primary energy consumption by sources of renewable energy. You can see Norway is the standout, the darker the better. I don't know why Brazil is also so dark. I mean, that could be a combination of hydro, solar, wind. I think in Norway, it's probably mostly wind. And we're kind of middling relative to some of the other large global economies around the world. But again, a work in process will continue to monitor this.
I heard Norway is running out of oil next.
Maybe, yeah, the Brent Sea crude is probably being depleted.
Right.
So they have a huge sovereign wealth fund that it's about 1.6 trillion in size. I had the privilege of sitting on a panel with one of the folks from that
Able to
sovereign
use
wealth fund.
it, like 3% of it
Yeah,
for infrastructure.
Yeah, but they've been really smart, Tom. They've actually for years have been siphoning off some and taxing the oil exports and putting it in the sovereign wealth fund. So a relatively small economy.
Like the UK, I think.
Yeah. Well, both, but Norway in particular has got a $1.6 trillion sovereign wealth fund and a small population.
Like about 9 million, I think.
Listen, I know Tom covered a lot of this. I don't have any. I mean, I've got some things that I'd be really interested to talk about. But why don't we skip ahead, Kate, to slide 40, and that's the money slide. That's the performance slide. And again, it's very dangerous for anyone to come here and pound their chest and say, look at the 1-year fiscal returns. You have a benchmark of 7, you achieve 10%. That's really great. That's a great outcome. But as we've seen with the uptick in equity prices, significant outperformance relative to normality and relative to expectations, it's not to be expected to continue necessarily. We're hoping that infrastructure and PE and some of the other private asset classes will pick up the slack, and we expect they will.
Slide up there for a little longer.
Yeah. Well, it's interesting too, and I just, you look at this and you say, well, I've been the CIO for 2 years. This is a great outcome. This really has little to do with the CIO that's sitting in the chair today. This has to do with people and decisions, and a process was put in place over time. This is your fund's over $100 billion. It's enormous. And it takes a long time to change. But as long as we're committed, I think it's called KATSU, which is continuous self-improvement over time. That's what we're doing. And I try to use the football analogy is everyone touches the ball. As long as we move it forward, we'll have good results. So I know we've talked about STAR. We're going to talk about this at BAM University. But the idea is how do we constantly improve everything we do and how we do it to make marginal increases as opposed to really dramatic increases that can impact something short term. With long-term investors, we have to remind ourselves that your plan, no one's all of us will be gone, your plan will still be here. It'll still be generating money and paying benefits to retirees. And we need to have that mindset, so. But a good outcome. Kate has advanced the slide, which tells me that she wants me to. Sorry. The next slide is a little disconcerting for me because if you remember last time I reflected the slide, the average portfolio value, this is if you invested, say, $1 back in 2014 at 7%. That's what that black line shows, reinvested. Your performance is actually the yellow line. We were actually above that black line the last time I presented this, but because certain periods of time will fall out and new come in, even though the performance has been strong, kind of counterintuitive. You just had a 10% annual fiscal year return, but we're still a little behind the benchmark again over that period of time. So our work isn't done. On the next slide, just to look at net public market returns. Again, these are your benchmark returns, not necessarily your specific returns. Actually, I beg your pardon. These are your, yeah. These are your, yep, TRS returns. And you can see again, I don't like to focus on the quarter results really in 1 year. As we talked about earlier, the Russell 3000 US equities up 23.4%. A very, very good outcome.
So that's 13.9% of 5 fiscal years, right?
Yeah.
Yes, yes. Yeah, it's annualized over 5 years is the return. Yep. So good outcome. Obviously, developed market ex-US equities been a little challenged. Again, we talked about Bailey Gifford. I know John Mercersburg and team have been addressing those issues as well. But again, a pretty good outcome. On the next slide, look at your excess returns relative to public markets. So a little behind in the Russell 3000 short term. 1 year, the excess return is 25 basis points. Again, developed market ex-US has had a little bit more of a challenging time, really with the dramatic sell-off in 22 and 23, and some recovery in the last year. Emerging markets have done quite well, pretty consistently relative to their benchmark. Again, a good outcome there. And then if you look at fixed income, that structured index is a minimum of 5-year maturity. It's got a little longer duration, but a pretty good outcome there as well in high yields, for example. On the next slide, just a different way of reflecting. So this is kind of a work in process. This is skunk work that Dan Haas has been working on to try to present things in a different format that may be more digestible. So this is a public market AUM on the left-hand side for your fund, and then the performance over those same periods of time relative to your benchmark. So I don't know if you find any value in this. I actually thought this was really interesting. And when we talk about some specific sectors, it becomes increasingly interesting. But again, more of the same information I've already covered in a different format. On the next slide, a look at fees. Again, we are continuing to try to work down fees in both the public and again, the private assets in your portfolio. And we're going to be probably more focused on the public market sector going forward as we change how we negotiate contracts, that we get our own ACO within the Bureau of Asset Management. We have our own legal resources. We anticipate being more nimble and again, being more aggressive in terms of reducing your fees consistently over time. So this just looks again, your fourth quarter fees for public markets were just under $27 million in fees. The bulk of those fees are in world ex-US at 6.8, emerging markets 6.3, and US because it's mostly passive, even though it's a lion's share of your assets, $4 million in fees. And you can look across on the right-hand side to see that representation.
1 second. We're getting a little reverberation. I think somebody who's online needs to go on mute. So if you could just check that. You have a lot of good things to say.
Yeah.
Here.
Yeah.
They listened.
Well, that worked. Great. I'd say the last takeaway is the far right-hand side, the lower portion. All strategies combined, 13 basis points in fees. And we intend to hold ourselves accountable for doing better and reducing those fees again over time. On the next slide, a look at your private manager returns by strategy. Again, for the 1 year sector, private equity, again, still recovering from, really lack of exits, mergers and acquisitions have been lower. Valuations are down a little bit, but still, a healthy return. If you look across the curve and see where you are in terms of private equity and its 10-year annual returns of really quite significant at 13%. Again, that's on average each year over 13 years. Private real estate, again, negative 6.7%. That has to do more with office. And I'll show in the next slide, John Glusak we're actually fairly well positioned. We're underweight office, which is the one area that's really been challenged.
What do you mean by the lack of office?
Well, office buildings.
Right.
So in commercial real estate, it's office, it's retail, it's data centers in some respects, it's multifamily, a whole bunch of different.
You don't think the office real estate will improve any?
Oh, I think it'll improve, Tom. It's a matter of timing. You know, in the last year, it didn't improve. It continued to decline. Defaults were up at the margin as well in commercial mortgage backs, mostly for office space. We're still wrestling with that whole remote work thing, return to the office. And again, the question is, you know, how much space you need, and what the space you do need is a fit for purpose. So again, we still wrestle with that here in New York and in many cities here. Less around the world. Japan, for example, is 100% back to work full time. They don't have remote work. So a challenge we have here still. I have to call out the infrastructure performance again, which I thought was extraordinary, 10.8%. We hope to provide some insights into infrastructure over time, and that's one of the strongest asset classes that we've had. You know, certainly a close second to, say, private equity, and then public equity in the public space. But again, a really good outcome there. Lastly, alternative credit, given the backup in yields, in base rates, and the widening of spreads that have subsequently tightened, a good result there. Net excess returns and basis points, and I want to ask: is Dan Haas on the line? You look at private equity. Good, Dan. I may need to call a friend on this because I'm unclear on something. So if you look at the private equity returns, it's the Russell 3000 again, which delivered 23.1% plus 300 basis points takes you to 26%. You take out the 5% that we've delivered in positive returns on the prior slide for private equity, and it looks like we've underperformed the benchmark more. Is the Russell 3000, is that lagged 3 months?
That's right. So the Russell 3 is lagged 3 months, and that's a PME. If I remember correctly, Hamilton Lane provided that for us.
Got it. Spent a half hour trying to figure this out this morning.
Yeah.
3 hours.
When you put it in basis points, it looks worse than percentage, right?
Yeah, it has to do with the significant outperformance of public equity, and a little bit of challenge in private equity. I think all the private equity equity investments we're making today will benefit from the challenges that we're seeing in the marketplace today. It's still a good time to put money to work. If you look across other asset classes, you know, excess return, as I mentioned, real estate, because we're slightly underweight office, we're slightly overweight multifamily, we're slightly overweight industrial logistics. There was outperformance there in the 1 year sector. And infrastructure consistently over the 10 years since its inception have delivered material outperformance in alternative credit. Sue's positioned the portfolio very well. Trying to wrap things. I do want to share one more slide with you, if you would, in the next slide. As I talked about a different way of presenting things, these are assets under management in your portfolio as of the end of June. What I find really interesting here is on the right-hand side, and I don't mean to steal Petch's thunder, but if you look at infrastructure, so this is your returns are actually darker, and the benchmark returns are lighter. That's significant outperformance over 1 year, 3 year, 5 year, and 10 year. It's kind of a confusing chart. It takes a little bit of time to sift through it, but actually really good outcomes. Similarly, you know, we've actually had strong performance pretty much across asset classes, but just a different way of looking at and presenting where we are relative to your established benchmarks.
So it looks like we beat the benchmark in each of those.
Yes. Yeah.
Dark and the lighter.
We were talking about this last night. Petch is too modest to say that she's going to be able to replicate this. She's embarrassed that I'm bringing this up, but and she reminded me that, you know, half the allocation still has to be put to work. So, but I have confidence. I think that's it for today, for me, for just the quarterly update. So a good quarter, good fiscal year, an interesting time. Again, summer's over. I know I
for reminding us.
told through the grapevine, we want to give you an update since we last met in June, what happened in July and August, so hopefully we covered that.
Thank you.
Are there any questions?
Any questions for Steve?
Steve, I don't know if it was the November meeting or maybe it was the January meeting, one of the last meetings, we discussed, you're gonna be looking at benchmarks and doing a deeper dive. I think, there was some concern that some benchmarks necessarily didn't match up with. So I just want to know, A, where we were with that. And B, as I was looking, I was looking at the stuff at 1 o'clock in the morning last night, so my eyes were a little bleary. And I noticed that against the benchmarks or against the indexes, we were not always beating the indexes on, over the fiscal year. So I just wondered, was there an aggregate number of how we did versus a composite of the index versus the, where we could have been, or versus excess return, whatever I mean, on aggregate. So it was up and down. My eyes were flipping around.
Yeah, it depends how you compare, who you compare yourself to. So we had one of the earlier slides shows a bunch of different comparisons relative to say your strategic asset allocation weights, if we were there, where we are today. Again, there are challenges associated with being such a significantly sizable fund that we're not quite as nimble as we perhaps would like to be. I'd also answer your question this way, Tony, that we're spending a lot of time trying to incorporate a quantitative rigor into everything we do and how we do it. We're trying to have, you're right. But we're trying to put much more science around what we do. And obviously you can have good insights and fundamental views on markets. We want to couple those with a strong understanding of what the numbers tell us. What do we know with certainty and what we can build on from there? So we've got a number of projects we'd be happy to talk to you about over time, but things that are trying to, again, look at where we are for benchmarks. And actually Dan Haas is involved in that as well from a financial reporting standpoint and from a risk standpoint as well. So more to come.
Thank you. Any more questions for Steve? Thank you, Steve. You get to call Ed Dr. Berg. Can we call you Professor Mayor?
That would be great.
That is excellent.
Very funny.
Thank you. Very well done. Thank you so much. So I think that concludes our work in the public agenda. So is there a motion to go into executive session?
So moved.
And it's been seconded?
Seconded.
And it's been seconded. All those in favor of going into executive session, please say aye. Those opposed, say nay. And we are now in executive session. We are back in public session. Liz, you'll. So.
Did I say Patricia?
Oh,
No.
Great, we are back in public session and Priscilla Bailey, great to see you live in person. We'll be doing the readout today. Thank you, Priscilla.
Thank you, Mr. Chair. In the executive session of the Passport Fund, there was a manager update, no action was taken. In the executive session of the Pension Fund, there was an update on preliminary performance data. The board received a number of manager updates. There were 2 private equity presentations, consensus was reached on all 2. There were 2 infrastructure presentations, consensus was reached on all 2. There was an alternative credit presentation, consensus was reached. Details to be made available at the appropriate time.
Great.
Thank you.
Well done. Thank you, Priscilla. And I think we've concluded our business in public session. Before we adjourn, I just want to thank our recorder, Will, who did a fantastic job today. And Daniel, our TRSNYC person, for assisting. So much appreciated, guys.
Thank you.
Thank you very much.
Thank you.
And is there a motion to adjourn?
So moved.
And is there a second?
Second.
And is there any discussion? Hearing no discussions, all those in favor of adjourning, please say aye. Aye. All those opposed, say nay. We are adjourned. Thank you.